Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. We also have David Llewellyn Smith, co-author of The Great Crash of 2008 with Ross Garneau, founder of the internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business Financial blog. Finally, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, please check out our people section at www.nucleuswealth.com. So hello and welcome to this week's instalment of Nucleus Investment Insights, and we've entitled this one, Is Your Fund Manager Swimming Naked? So this has come about from a recent inquiry or a story we heard from a prospective client who thought he was in quite an income-focused fund that he took on to believe as low equity exposure, and then as he found out, and as we'll work through in today's presentation, it turned out to be anything but, and given the recent market volatility, he learned the lesson the hard way. So we thought we might good opportunity to for Damien to throw out his thoughts on what he thinks, or some ways that we can have a look at whether or not what fund managers are doing is actually, or what they're saying they're doing is actually happening.
Yeah, sure. And I think, Tim, the key thing I wanted to try and get across is that right now it's a tough time right now for fund managers and for anyone trying to pick a new fund. It's very hard to find something that hasn't fallen substantially over the last couple of months, and then so the question has to come back to saying, well, if everyone's down, how should I mark the guys that are down more or down less, and is it a bad thing or a good thing? And it really, for me, depends upon what products they're in, because there are certain markets that, say, the government bonds that have risen. So if you're in a pure government bond fund, then then you would expect to go up, but that doesn't mean it's guaranteed you're going to go up and you're going to outperform all the time. But it is a good defensive fund. So trying to work out how you should be looking at the results and whether you and so maybe we'll jump into the
presentation proper.
Yeah,
sure, no worries. Okay, so we'll jump into an agenda. So we'll just cover it off on four, I guess, key things to think about. So are the assets what you thought they were? Are the funds invested how they should be? Are your funds tactically allocated, or are they just fully invested all the time? And finally, are your fund returns too stable? That's an interesting one. I can't wait to hear the thoughts on that one as well.
Yeah, sure. And so I guess getting into this sort of what are your assets? Yeah. So the main thing I wanted to sort of address here is that it's coming back to that person who'd bought an income fund thinking that it's very stable. And so the main thing I'm trying to get to is that there's lots of different types of income funds. And so if you've bought a government bond income fund, that's generally is very stable. And when you see markets fall off, the government bonds generally rise, and we've seen that come through in this episode. However, if you're buying there's a number of other different types of income funds. Some of them are income funds that might be property-based income fund, and so with the Australian property market falling quite precipitously, those are you might still be getting this nice income, but your capital's all of a sudden at risk. And I know there's certainly, if you look through the newspaper and see some of these, some of the ones that sort of target in newspapers because they're read by older people, and they target people talking about these, 7, 8, 9% returns, which are, and quote about how good they are. Often they're the types of returns that institutional investors would say, well, I need a 15 to 25% return. So for a higher risk property
investment,
yep. Institutional investors generally somewhere between 15 and 25, depending upon the nature of the risk and things like that. And often these funds get bundled up and sold to retail investors for 7, 8, 9, 10% returns, and the person thinks they're getting a great deal, and they probably, from a return perspective, it's 9 times out of 10 you're coming in and getting the money, and then the 10th time you're losing your capital, and all of a sudden that's where the problem starts to arise. So
what you're saying there is sort of in a like a GFC style event when the property funds were frozen. Sort of that sort of scenario.
Yeah, okay. Absolutely. Yeah. So you get so the issue there is they get frozen. The other issue is often with property funds there's often gearing behind it as well, and so you're not the so if something goes wrong, they might have geared the property to 60-70%. And then gone out and borrowed more money from you as a sort of a mezzanine loan, they call it, or even some sort of equity type, quasi equity. And so when the property falls by 30% because the developer can't finish it or whatever happens, the bank walks away with most of their money, and you end up with having to take a haircut on
whatever's left.
Yeah, that's right.
Okay, sure.
And so there's that part. Then you can start moving through some of the property, some of the listed property, and also the equity income funds, and also corporate debt funds. So corporate debt funds they've fared not too bad in this sort of downturn, but you do find that when you do go into serious recessions, that corporate debt funds can really suffer because the default rate jumps up quite substantially, and so we haven't seen that in this sort of latest market sell-off. But what we have seen is the equity funds, and the equity listed funds are the ones where they've been hit quite hard, and quite often they do get hit sort of on a similar basis. So I've got a chart up of and I blame Iris, and potentially it's just somebody sitting at Iris 20 years ago typing something in who decided to break out.
So just quickly, when you say Iris,
sorry, yeah, sorry, they're a data provider for a lot of intermediaries and a lot of stockbrokers and planners in the Australian market, and they decided to break listed property. So if you go out and buy, your Stocklands or whatever on the stock exchange, they then put that into a different bucket than if you go out and buy BHP or one of the banks.
Yep.
And so I've got a chart up showing a similar type of thing to what our what this investor showed, what the investor talked about, where it's got domestic shares of 12% and international shares of 10%, and then it's got these big sections for listed property, domestic listed property, and international, and then some fixed interest and cash. And so I think a lot of people will naively look at these and say, well, I've got international shares of 10%, they're pretty risky. I've got the domestic shares of 12%, they're pretty risky. Oh, well, that's only 20% total return, total risk of, 80 something, almost 80% of my fund is in safe assets. Whereas in reality, you do actually have to add in those domestic listed property, and the breaks between those are you'll see things in the listed shares that they're actually a lot safer than property, some of the utilities and things like that, and vice versa. There'll be some very high risk property stuff that can end up in the domestic. So I guess where I'm trying to get to with this is you need to know what you've bought.
Yep.
And so if something's gone wrong and you're looking at a return going, that's not what I was expecting from this fund, the question is first, have I bought something different to what I thought I had? So the next question will be, is your manager doing something wrong? But the first question you should be asking is, what do I actually own, and do I own what I was expecting to?
And so really, I guess and this is really about getting a firm idea of the classification. So rather than just saying, okay, I'm sitting in a 20% aggressive or 20% growth, 80% defensive mix, which as our example, I think it was actually significantly lower than that. And then, but what he didn't find out, or what wasn't immediately available, and when he made the investment, was the fact that property was listed as this giant, and a fair bit of it, from the sound of things, was listed as a defensive asset.
Yes,
and it behaved like a growth asset when the markets fell.
Yeah, exactly.
Okay.
So the question's coming back to saying, have you? There's two questions you can ask. One is it the fund manager's fault? And the other person is it the person who's decided to buy the fund? So the fund might have done a great job relative to its benchmark and what it's trying to outperform, because everything fell, but you're actually in the wrong asset class. So first question, making sure that the asset class you think. And I've got a chart up just on the next one, just sort of showing that what I spoke about a little bit earlier, the government bond fund versus, I've just used an ETF. There's a Australian shares high yield ETF, which basically just screens the Australian market for large cap stocks with high yields, and you can see that that's sort of off 15%-ish, a little bit less than 15% over that time period, whereas government bonds was very stable and rose over over that sort of same period.
As you would expect, I guess, essentially doing its job.
Yeah.
Yep.
So, and it's, guess, just really highlighting. So the first bit is making sure you're in what you think you're in. Then the second part is, now is your fund manager doing the job that they should be doing? And that's a complicated question as well. So I might jump on to the next one. So I've sort of got two different types of fund managers. Two different types of fund managers. One's a style manager, where they choose, they're either like a growth manager or a value manager or a quality, or there's a number of other different blends. But they've sort of told you that, hey, if you give me your money, I'm going to go out and invest in quality stocks, or I'm going to go out and invest in value stocks, or whatever.
Okay.
And so the issue when you're investing in these guys is, let's say a value manager in particular, they're the ones that tend to be, when the markets are going ballistic, they don't tend to rise as much, but when the markets fall, you do well in those ones. Well, you generally do better than the market. So not as much of a rise on the way up, but you're protected on the way down.
Sure.
The issue you've got is, let's say for value, is we've just been through this period of 10 plus years where value's been underperforming. We've had this great market ever since the financial crisis sort of bottomed and markets were rising. So every single month, most months, these managers are turning up and saying to their investors, well, we underperformed the market, but we did quite well because we're a value manager. When things turn bad, we're going to be here for you. And
after 10 years,
of that, there's 120 monthly reports you've written, in 100 of them explaining why you're still a value manager and all that type of stuff. So the danger is that you've given your money to a value manager and they've started to drift away from the value, because they've just sort of, after report after report, they start going, well, maybe I do need some Tesla to give myself a bit of juice in here, or maybe I need some of the some more growth into the portfolio. So that's one element you need to be watching, is if you have bought a fund because it's a defensive fund and it's not acting like a defensive fund, the question needs to come, is it because you've had this what they call style drift, or are they?
And so I guess just for someone sitting at home, how easy is it to determine the style, so to speak? Is it something that's sort of touted as like, obviously I'm sure there's managers out there that just say, I'm a card carrying growth, but is that always the case, or is it? Can you sort of ring up your fund manager or ring up whoever's managing money and say, I've just heard about this style business, and how do I find this out?
Well, it should have been something that's in like most of them will include it in their name, as opposed to whether they're but certainly within the blurb on the fund, you should get some sort of feel about whether they're growth or small caps or things like that.
Okay. Or an advisor could figure it out for you if you're using an advisor.
If you've got an advisor, absolutely, they should know. They should have put together your portfolio knowing what they've got.
Okay.
And so the issue for these ones is, if you've gone and bought a high growth manager and they've performed really well on the way up, but then lost you a lot of money on the way down, it is hard to. And they've performed similar to most other growth stocks. It is again hard to blame the manager for it. It's about what asset you've bought, and if they're trying to buy growth assets, then that's what their mandate is. there's other ones that are the hedge funds and the black box ones that I call, and they're the ones more that are just saying, look, just trust me. I've got this process, and I'll sort you out, Tim. Just give me your money, and everything will be fine.
And a very open palette.
Exactly.
What I can invest in.
Yeah. So there's some that are that are extremely wide. And they're the ones generally it's quite worrying to. As an investor, from my perspective, if I look at a fund, and there's basically no restrictions on what it can buy or what it can do whenever it feels like it. They're the ones that can be quite concerning, especially if you don't think they've got, or if they may not have all the checks and balances in place.
Processes.
The processes, yep. Yeah, and a long history of sort of their performance.
Yeah, that would lend to me, I guess, as being sort of the jack of all trades and master of none. Is that sort of the line of thinking, or is it just that they say, well, look, rather than trying to create a defined set of boundaries that are effectively our playground, we'll just say, oh, let's just have everything, so we don't have to deal with the compliance later if we need to get into derivatives.
There certainly are some in that boat. There's other ones that do have, there's a lot of hedge funds that have quite structured investment, and some of them are black box intentionally in terms of saying, well, we're very structured, we make this returns quite consistently, but we don't want to tell everyone what we're doing because otherwise everyone will start doing it. And there is there's an argument behind that, but you do need to watch and be quite careful about when you've bought those ones, and especially now, if you've bought a hedge fund or an absolute return fund because you were expecting this thing to give you steady returns, and you're finding that it didn't rise by that much as the market rose, but now the market's falling and it has fallen sort of 5 or 10%, then you have to be a lot more concerned and reevaluate your investment decision, because a lot of the hedge funds in particular charge quite high fees, and if you're not getting the performance for your fees, then and the average hedge fund you certainly aren't. Most in the average hedge fund over the last 10-15 years, they've tended to underperform the market on the way up, but fall when the market falls. Maybe not as much as market, but sort of you've had a limited, and for that privilege you've had sort of to pay 2 and 20 or something like that. So making sure that if you're in these hedge fund black box, that the returns you're getting now are consistent with what they're saying, and especially if they're running like an absolute return fund or some sort of hedge style that's not meant to lose money, but they are actually losing money, then you need to reconsider whether you want to keep going with them as an investment. Sure thing. So I guess the summary for that was the first one was about the are you in the right funds, and the second one now then is, okay, if you've got your manager, are they actually doing the job they say they were doing? And then so you can sort of come back to try and work out what's the what's the positive or the negatives. Should you be reevaluating and doing it or not? Okay, sure thing. So we'll jump into the next one now. Tactical asset allocation. Yeah. So now there's a couple of different ways people allocate funds between bonds and shares and cash, and it's all about getting diversification, having a few different things to a few different assets that go up and down at different times. So there's two main breakdowns you have. One is strategic and the other one's tactical. So strategic is basically saying, look, we don't know what market's going to do, so we're just going to buy this fund. Well, we're just going to buy this percentage, and so Tim, you've come in and we think you're a 70% equities, 30% bonds type of guy, and that's what we're giving you forever. Okay. So in you come and you're off and running, and markets will go up, they'll go down, equities will be overpriced, we're still buying 30%, bonds will be underpriced, we're still buying 30%. That's what you get. And so for those guys, if you've invested one of those, again, you've got what you've got. It's hard to argue with it. There is a question about should you be in strategic or should you use tactical, and there's a huge debate about which one's right and which one's wrong. We prefer to sort of lean in, so that when tactically, when share markets have a good run, you take a bit out of your share market and you put it into your bonds and cash, and then vice versa, when share markets have pulled back, you flip back the other way. Okay. Other people just go, no, I'm just buying this at the same time. If you are strategically asset allocated, you want to make sure though that didn't creep up. So equity markets had a great run. You want to make sure that your 70% didn't turn into 78% and they didn't rebalance you back, and then the markets have fallen and done the rebalancing for you. Yeah, sure. So the benefit of strategic is at least you rebalance keeping on rebalancing, and you get some of that.
Well, it sounds like the key. Yeah.
Yeah.
It just has to be regularly rebalanced to make sure you're in line. Okay. Yep.
So on the tactical side, that's where so we do a lot of that. But the idea with the tactical side is that you wanted to see managers when markets were up 20% or whatever they were, starting to take some off the table. And so that's the generally, what you'd be expecting from your tactical manager. Maybe they've got a good if they didn't do that, maybe they've got a very good reason, and they'll explain it, and that'll be everything will be all right. But in my mind, markets were quite expensive. Most people are talking late cycle. There wasn't a lot of justification to be sort of throwing more fuel on the fire at the right at the peak, and so most tactical managers would have been pulling back and reducing the equities.
Okay.
If you happen to be in a low risk fund, so just ballpark numbers. So if you're in a higher risk sort of growth fund and you're falling by about the same amount as the market, you'd probably be a little bit concerned. You should be, even in a higher risk one, you shouldn't be falling as much as the market, because you should have had some bonds and cash and other bits and pieces in there. Maybe not heaps, but you should have at least have some. So you probably shouldn't be falling as much as the market if you're in a higher growth one.
And so what's a percentage that people could look for, perhaps now that they've got a bit of time over Christmas, to have a look at their super fund for the year, perhaps, or recently? So
if you're picking over a particular period, if you're talking peak to trough, the market's probably down 13-14%. You wouldn't want to be down that far on your growth fund.
Which market? World market.
The world markets,
okay.
And the Aussie market's probably pretty similar. If you're in a low risk fund, you probably want to be about half that, and probably better. I think especially a lot of low risk funds usually should be pretty overweight bonds and cash. And so especially in the very conservative ones, you'd probably want to if you had a negative 5%, you might even be concerned.
Oh, absolutely. Okay.
So you should be a couple of percent down maybe, and maybe even a couple of percent up depending upon which funds you're invested in.
Okay, good point.
So that's the sort of tactical versions. Then you've got your versions. There's a bunch of versions out there, and we run a couple ourselves. Where we run an international fund where we're just in international shares at all times. So if people want to invest in international shares, they give it to us, and we'll go and invest in them, with the view that people are doing their own asset allocation.
That's right.
And so, whereas there are other funds out there, and Magellan's got one that's probably one of the highest profile ones, where they do something similar, where they invest in international, but they can go up to 50% cash.
Right.
So that's what I sort of call a tactical overlay fund. So it's got pluses and minuses. If you're trying to do your own asset allocation, the problem can be that you go and give them $100,000 to invest in international for you, and the international does really well, and they turn around and say, "Oh, sorry guys, we were 50% cash because we were worried about it," and you're like, "No, I was doing that myself over here."
That's right. Yeah, you're allowed to wait.
You can be at cross purposes. On the flip side, if you're not doing your asset allocation and you just give them the money, at least they're going to go, "Well, stocks were pretty expensive, so we put some in cash." So it's pretty hard to judge how because these guys don't really fit into either one of the buckets. So they're not really a tactical one, because they're not actually out buying bonds and other sort of things to give you a proper diversification. On the flip side, they're not 100% invested, so they're sort of sitting somewhere in between. And so again, I think that, to me, I find it very hard to judge the performance of these ones. I think there's you need to work out what you're trying to get out of it. And so if you want an international exposure and you're doing the asset allocation yourself, then go buy a fund. There's heaps of them out there, and Magellan's even got a few of them that are fully invested at all times. And if you want the tactical piece, in my view, you should go to somebody who does the tactical piece. But so these ones are sitting in between. It's very hard to judge whether it's the right product. You need to work out if the right product for you.
It's essentially just wearing two hats, and I suppose that's a problem, because if you not know if there's one like this out there, but I'm sure there is. If you went to an Aussie style one that's similar to Magellan, then there's a potential that 50% of your money, even what you think was a diversified equity sort of arrangement with some international and some local, would then actually be sitting 50% in cash potentially on both sides, and those managers probably aren't talking to each other. Actually, that's often the danger, especially even some of the ones that don't run. We tend to try and run our tactical asset allocation from top to bottom, so that we've got our bond portfolio and our equities portfolio talking to each other. But there are certainly people who put them together as one manager
from one group and a different manager from a completely different group, and so you got a bond guy thinking, interest rates are going up, and he's done one way, and you got the shares guy thinking that they're going down, and you've got your portfolio working at cross purposes. So,
or cancelling each other out.
Yeah, that's right.
Yep, sure. All right, very good.
Yep. So that's the tactical side. On the returns too stable, and yes, it is a problem. It can be a problem.
So what does that? We might just need to flesh out what a too stable return means.
Yeah. So the question, particularly if you're in, say, a higher risk hedge fund or one of these black box funds where you've come to them and said, yeah, I'm quite an aggressive, or I've got quite a high growth preference, and so you might have 70-80% growth, and you're looking at this fund and it hasn't fallen over the past couple of months. It's sort of flat, and so that might be a fantastic thing. They might have done a fantastic job and found the assets that needed to be found or whatever, but there's also a couple of things other things it could be. One is it could be fraud. I mean, there's a low chance, but it's worth paying attention.
So when you say fraud, it could be just what's an example of fraud in the institutional space? So
Bernie Madoff was probably one of the poster children for this one. So he had a fund that just clocked in, whatever, 0.5% a month, every single, just like clockwork, just all the time. Returns barely varied. Everyone spoke about what a fantastic fund it was. We've got to buy this because the markets go up and it just makes this return, and the markets go down and it makes this return. It's just this is the best thing ever. And the reason why it was the best thing ever was because they were just making up the numbers.
Yeah, gotcha.
So,
okay.
It's not. It's unlikely, but well worth if you're looking at returns, going, how well have I done? Just it's worth.
And there's an element of that knowing who actually creates the numbers, perhaps, as well. So obviously the fund or the organisation can create its own results, but is there some way
being done externally?
Yeah, that's right.
Calculated externally. That's often the key of, and making sure that the structures behind it. Like, so as if you're looking at a fund as in terms of whether you'd want to invest in it as a professional investor, there's a number of things you'd have about the auditors and the compliance and the sign-offs and things like that.
Ratings agencies.
You go through your check boxes to say, and the types of structures where you go, well, if it's in some sort of hidden structure where they can basically do whatever they want and get their accountants to dodge up the numbers, it's obviously a lot harder to
convince a third party.
You want to put your money into one of those versus something where, for example, some of our funds just sit on third-party platforms, and the platforms do all the administration and the reporting of reporting of investment returns and things like that.
Okay, sure. Yep.
So not enough risk is the other one. So there's three main things on the so if, say, you've got lots of cash and lots of bonds, that's a great thing for the past couple of months. It's worth just making sure, though, that that's not something you've had sitting there for 5 years because you've been waiting for the market to for the end of the world, and if you don't do anything, another 15 years, you'll still be sitting there waiting for the end of the world to happen
and charging a fee
and getting charged fee, or even just sitting there with when you look over longer periods of time, you find almost invariably, if you look over a 20-year period, for example, that equities are going to outperform bonds, which are going to outperform cash. And so if you're sitting in cash or if you're sitting in bonds for too long of a period and you're not taking any equities, then you need to consider, are you not taking enough risk to get returns?
Sure.
And so if that's your problem, it's a good problem to have at the moment, but just worth making sure that you've actually got some trigger points and a plan to actually get invested.
And so once again, just sort of relating it back to sort of someone who's listening at home. So how would you go about actually determining that point number 2, not enough risk? So is that something that that a person could say, okay, well, maybe I'll get the return or market or an index return based on how the fund was set up when they sold it to me, potentially? Or is it sort of, do you know what I mean?
I'm thinking more, I guess what I'm thinking is more about the people who are sitting in cash themselves. And we see a few of these, personally, who's sitting in cash and have, I've spoken to a number of people who've been sitting in cash, but they've been sitting in cash for 5 years because they've been through the financial crisis. They're like, this is terrible, and the world's economy is terrible, and it's never, it's all propped up by debt and
paralysis by
fake
analysis.
Money, and the investment just sits there and never gets invested.
Sure.
And so I guess what I'm trying to get to there is, if you have something where you go, well, look, I want to be 50-50 weighted, or whatever the right weighting is for you in terms of equities versus cash and bonds, is that you have a plan to get there. It's not just, I'm going to wait until I feel comfortable and then I'm finally going to invest. It should be, well, look, I know I need to move there, and maybe I'll put in 5% every 6 months until I get to
where I'm aiming
where
for.
I'm at, or 5% every 3 months, or whatever it is, to get to the level that you've actually got a plan, or here is the level that when the market reaches this level, I will be buying, and written down and acted upon, because that's where most investors generally underperform. Professional investors, for a lot of that reason, is because they'll sit back and wait until everything looks great, and that's usually close to the market top.
Yep. Do you find as well in your experience that the thought processes of retail investors, and we've covered off on this a little bit in the past, but they're quite binary. It's either all in or all out. It's a switch that you go, okay, now's the time, and I'm either going to love it or regret it, as opposed to ticking into a various asset, like vis-a-vis perhaps something that you do at an institutional level.
And there's times, and I've been there a couple of times over the last few months, where you're looking and saying, well, there's a couple of different paths the economy can take, and a couple of different paths you can take from a number of things. And I'm sitting on a portfolio where I know I'm going to be disappointed either on the upside or the downside. But if I think I'm equal, you're sort of trying to tread this middle path. And so, and that's part of investment and I think for a large part, financial advisors, for a lot of people, are more like a psychologist than because a lot of financial planners aren't actually doing the investment themselves. They're giving it to other people to do the investment. They're really acting as a bit of a sounding board and a psychologist, just to say to you, look, Tim, I know you're really scared, but you've got to put some of your money to work, because you've been really scared for the last 10 years, and it's,
Yep.
and you're missing out on all these. And
as you mentioned, there's a diving board approach, and then there's the stairs next to it where you can just sort of slowly work into the water.
Exactly, that's right. Yeah, and I'd suggest taking the, especially if you're nervous at all or concerned, then take the stairs. Yeah, absolutely. But you need a plan to take the stairs. Not just I'll just sit next to the pool and wait, dangle the feet in, and go to sleep. Okay, sure. All right. Finally, unlisted valuations. Yeah. So, especially some of the there's a lot of super funds that have quite substantial unlisted stocks sitting within their portfolios now, and the issue with these is that they only get report because they're unlisted. You need to know when they're getting marked to market,
which means valued.
Which actually valued, yeah. Yep. And so, because what can sometimes happen is, you've got shares. They've got shares sitting in a portfolio. Let's say they've got some REITs and some property and things like that. Listed properties just fallen 10%. Mm-hmm. They're sitting on these other assets and saying, well, we haven't revalued any of these assets, so
we're going to call it X.
So we're going to call it the same.
last year's value.
Yeah, so it was $100 last year. It's still $100 today.
Wow!
Because you haven't revalued it, and then but they'll have things about they often I think it's usually every 3 years or
that still seems like a very long time compared to a market which is valued by the minute.
Absolutely. So, and that's the main thing, is when you're looking at the returns and saying, okay, well, here's a fund where the returns haven't changed, and you're saying, well, is that because they just haven't updated the returns? You haven't hit refresh on your spreadsheet type thing. Yep. because they're unlisted assets, and so there's not a price for them.
Sure.
And the danger you get into that with those is when when the assets actually have fallen and people know about it and start getting out of the fund, and you don't know.
Yeah, okay.
So the example, and I used it's sort of an more extreme example, but just to sort of show you that if so let's say, Tim, you and I have a fund together, we're both in it, we both stuck $100 into this fund, so it's worth $200. The fund's gone out and spent $100 and has just left it in cash, and the other $100 it's bought some unlisted shares in property. So let's say that property goes down by 20%. So it's down by 20%. Our fund should be worth 180, but it hasn't been marked to market yet. So it's still telling us it's worth $200. Yep. And we're still, in theory, we've both got $90, but we're happily looking at our fund statement saying, oh no, I've got $100.
Yep.
Now I decide that I want to get out. So I go to the fund and say, here's my fund, it's worth $200. I'd like to get my $100 back.
Sure.
And they have a look and go, well, yep, that's what we're telling everyone. So they give me the $100 worth of cash.
Yep.
Now you're left with,
rather than a 10% fall, I've got a 20% fall.
Yeah. So, and there's a lot of in the unlisted space, in property in particular. There's a lot of these funds they know in advance whether things are going to get marked up or marked down, or where they are, or they're looking and going, okay, we've got we've got 3 different properties in this area, and we know properties in that area have fallen by this much or risen by that much.
Sure.
And so they can jump in, and
right.
where there are some sort of markets, they can either get out or get in at favourable prices, because they know these things are going to be marked up or marked down.
Yeah, okay.
And so there's sort of, so unlisted is, I guess,
sounds a little bit nefarious.
It certainly is. but I guess there's two parts. One is, if you've got lots of unlisted assets and they're not being marked to market properly, are you giving up something, especially when markets fall?
Yep.
And the flip side, and then the other part though as well, is when you look at your statement and it looks nice and stable, is it looking nice and stable just because they haven't revalued? And so then you just have to sort of take that with a grain of salt.
And I guess, once again, for the casual observer sitting at home, like that's a terrifying one. I think you've just given that example. But how once again, how do you get granularity on, or visibility on that sort of thing? Like, someone could be sitting there assuming that they're in even a liquid property market, as opposed to is that something that's written on the packet? Is that how do you is it in the ratings process or something? How do you know?
Oh well, look, if you look through the statements, they'll tell you how much they've got of unlisted.
Okay.
I mean, something like especially a lot of the big industry funds have got lots of unlisted stuff. So I guess there's you can get a little bit from that, but I guess it's the point of coming back to it's hard to assess these things, and I guess these are the things as you're looking at a return, especially if your returns haven't fallen much. You might just want to double check.
And I guess ultimately it's just about seeking out investment opportunities that offer that sort of transparency, perhaps, as well.
Yeah, but my personal preference is that you have transparency, and you get all the assets sitting in your own name and all that type of stuff. That's sort of the way I try to set up funds. But I can see there certainly are benefits from the fund managers of having these unlisted valuations, and it looks a lot more stable. But the flip side as well is you do get lockups as well if you're in those ones. That's the one to keep an eye on.
Yeah, sure.
Because if you do have unlisted valuations, and let's extend our example and say there were 4 of us in that fund we were talking about before, and 2 of us or 3 of us turn up and say, oh well, now we want our money back. The fund goes, well, I haven't got enough money to pay back all 3 of you, so I'll only give you part of the money until I can actually sell that asset.
And then it hits the papers.
Yeah, that's right.
And then you're in big trouble.
Everyone wants it. Yeah, so the issue with too much unlisted is there's
liquidity stops.
Dries up. Yeah.
Okay, very good. All right, well, on that note, we'll hear some more about Nucleus Wealth. Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency of what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio managed daily by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. In our new personal superannuation option, we have partnered with Praemium, who is backed by HSBC as custodian and ANZ for cash management. We feel these structures are the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment, to ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating only the areas that are important to you, you avoid missing out on the potentially higher returning areas that you are ambivalent about, which are often ruled out in other broader ethical investment options currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they have experience in. We also offer a complete investment solution for those who don't have the time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide.
For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.
Okay, so while we were rolling the notes about Nucleus Wealth, we ended up getting a question, and it says isn't it incredibly difficult to judge performance over time because of the large amount of time required? For instance, I think that I read once that a fund manager can't really be judged until they've been excelling for 25 years, because under that might have been luck. That's a pretty healthy lucky streak. And there's an example given there: good-looking returns, incepted in 2009. So how well do you know the manager and the market?
Yeah, hit on a very important point. It's very hard to tell from there's a whole industry based around this trying to work out whether fund manager returns are real or not. They spend a lot of the ratings agencies spend a lot of time with it. There's having been through a lot of those as well, you get a lot of funny questions about things like that they're interested in people going through divorces and the personal situations and how old, what's the optimal age for somebody. And
so these are like ratings houses, or
because the question is, if you've got somebody who's 40 or 50 and they've got 10-15 years to go up this thing, and then all of a sudden they make a lot of money, and the question is, well, what are they doing with that money? Are they out when they were 40 with no money or with that much money, they're out working hard, and now they're 50 and they're a billionaire,
bought a yacht.
It's out, exactly, or onto the third wife and those types of things. So they can get pretty esoteric, but it's with any manager, it's very hard to work out the luck versus skill part. And I think Warren Buffett, again, to bring back another quote of his, is they said, well, if you had a coin flipping competition in America and you got everyone involved in it, the thing is there would be a winner, and that winner could be sitting there telling everyone about, I make sure I spin my finger in this direction or whatever to whatever, but in the end somebody had to be the winner.
Sure.
So somebody had to get lucky enough to make it through. And so it's that part about, and I'm not helping people, but in terms of fund managers, hopefully the tips from today are sort of along those lines of saying, well, there are some things you can do to try and work out whether it's been luck versus skill, and some things you can do to try and work out, well, are the returns everything they look like they should be.
Okay, yeah, sure. And just a quick one, actually, and I think it was sort of in the spirit of that question as well, where the listener offered an example of a fund that was opened in 2009. Obviously, you were in the industry over that time. I was sitting in the Pilbara, but did you find that there was, I guess, essentially, want of a better word, some churn where people could basically restart in a post GFC?
Absolutely.
Okay.
If you're with a big fund. A big house that has a number of funds, then you're starting funds, semi-regularly, and part of that is because you've got a sales force who are out selling things, and you'd like to have different funds because Joe in the corner is going to be the best performer over the quarter for this month.
Yep.
And all your sales force can go out and push his fund, and then he'll underperform, and Bill in the other corner will be, and then Sarah the next month is a performer. And so you wanted diversification, and the more, if you've got funds, some funds started earlier, some funds started later, you can come up with a story for the
whole lot.
You've always got something to sell. You've got a sales force there who needs to get out and sell these funds.
Yep.
So the more diverse you can find in terms of when they started, when they what their strategies are, what they're doing, the better for you as a fund house.
Yeah, sure. Okay, no, great point. Oh, very good. Thanks, Damien. So I'll just jump back on track now. So we've got, as always, I'll let you know that our personal superannuation option is up and running and keeping me very busy. You can head over to portal.nucleuswealth.com. It gives you an opportunity to select your ethical themes. As mentioned before, we've got 19 different ethical themes and a couple of portfolio screens. We've also loaded up 40 plus of the biggest funds in Australia by size and by membership, where it gives you a range of comparative fees to give some level of subjectivity to our fee estimates that we give you in the onboarding. And of course, as always, you can seek advice. So you can either choose from our portfolios yourself, you can get some help internally, I guess, essentially, in limited advice, they call it, on an appropriate investment for you, or we can make a referral to a third-party group of face-to-face advisors if you feel that's what you need. Coming up, so next week, we're over the Christmas holiday break, we're going to drag one out from the vault, and we thought, given all the recent market volatility in the last few months, we thought we might pull out one of our more favourite ones, which we've entitled Good Defence is the Best Offence, which we actually went live with a couple of months ago. We had some good feedback from that one. What it does is really just run through the building blocks, I guess, of the defensive elements of a portfolio, what to use, what potentially not to use, and of course what we use. So that's going to be available. We'll post it up on the live page, the Nucleus Wealth live page on the 27th of December, 12:30, and you can also find it if you want to get in before then on our YouTube channel, and of course wherever good podcasts are found. So we are available on Spotify, iTunes, Podcast Addict. If you'd like, head over to bit.ly/Nucleus Insights as well. If you've got some time, maybe over the Christmas break, if you wouldn't mind giving us some stars or writing a review, give us a bit of feedback or some accolades or otherwise, and it just helps drive people to check out what we do and get our message out there. So on that note, thank you very much for attending, and we'd just like to say, as our final live one for 2018, all the best for a safe and enjoyable Christmas break, holiday break, Kwanzaa, Festivus, whatever takes your fancy, and we do wish you all the best for a safe and healthy, prosperous 2019, and we thank you for all your support going forward. So on that note, I've got a lot out of today, and I hope you did too, and I look forward to catching you at the next one in the new year. Cheers.